Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. And we're going to discuss some of the key themes driving markets. These include global inflation, the outlook for the UK economy, US tax reform and the future for risk assets. Mark, let's start with the interest rate environment, which does appear to be tightening in now. Clearly this has been coming for some time in the US, but is it now a realistic prospect in the UK? And what's driving it? Is it growth, inflation, or perhaps both?
I don't think it's any of those actually, and I'll come back to that in a moment, but you're right, we've been on a sort of gently tightening cycle in the US for a while. We've obviously had an interest rate rise in North America, we've got more expected, and that's been leading the way as the Federal Reserve looks to normalise monetary policy after this very long period of abnormal monetary policy that we've had with quantitative easing and so on and so forth. I guess the surprise has been the Bank of England's really hawkish stance that it's taken over the last few weeks. We've had an uptick in inflation in the UK, but really we think that's a one-off as a result of the currency weakness we saw last year. Outside of that, we don't see a lot of inflationary pressures in the UK, but it appears that the Bank of England are getting really quite concerned about that and want to stave that off. And also, I think also by the level of consumer indebtedness we've seen build up in the UK economy in light of the quantitative easing that we've had for some time.
And what does this mean for the outlook for the UK economy, particularly in light of the current state of play regarding Brexit, of course?
Well, the state of play with Brexit is obviously pretty fluid. We had the Prime Minister's pronouncements in Florence a couple of weeks ago talking about a transition period, which we think is a positive development. But that, however, does have the effect of continuing the uncertainty or delaying the uncertainty, if you like, with regards to what the relationship the UK is going to have with Europe post-Brexit. And I think that uncertainty, along with, as I said, the consumer probably being about as indebted as they want to be, has led to a slowdown in growth in the UK. So the hawkish stance adopted by the Bank of England appears to us to be coming at a time when the UK economy is slowing down. So raising interest rates into that, we think is going to be a relatively negative experience for the UK economy and probably not needed in the longer term.
And how is all of this likely to impact sterling?
Well, sterling rallied on the news, but had been on a gentle glide path downwards in advance of that. And if we look at what's happening in the UK economy in terms of growth slowing down, if we look at the ongoing deficits we continue to run, particularly in international trade, we think the weakness that we're going to continue to see, we would expect sterling to probably remain under some pressure going forward. And the interest rate rise may stave that off, but I think in the medium term, I think sterling will continue to be a weak currency.
Moving to the US, Donald Trump once again is looking to reform the US tax structure. And having seen growth prospects disappoint, does tax reform have the potential to reignite the growth rate?
It does have that potential. Clearly, in the aftermath of his election last year, international investors got pretty excited about the growth outlook for the US economy, and companies in the stock market exposed to that growth performed very well. It came into 2017 and he was unable to get much of his tax reforms through, and growth expectations came back. So this has been an ongoing process for him to try and structurally reform the US economy, get the tax system more competitive, repatriate much of the international cash that we've seen sitting on US companies' balance sheets outside of North America. Now the problem is that without reforming the healthcare system, he can't really afford this, so they have to go hand in hand, and so those negotiations are going to be complicated to get through and complex to implement. But if he is able to reform the tax system, get international cash repatriated that's currently sitting on the balance sheets of many international US companies, then that will have the potential to give a stimulus to US growth and push it up from the sort of 2% level we're expecting at the moment.
Okay, and risk assets have continued to perform well, particularly credit. What are the prospects for markets and what's our view?
Yeah, there have been multiple drivers to that ongoing credit performance. Clearly bond yields remain low, and so there's been a bid for yielding assets more broadly. That's supported all risk markets, equities as well as credit. We've obviously seen a lot of central bank buying as part of the quantitative easing programme. And that has taken supply out of the market, and also the economy has improved, and that's been positive for credit. If one looks at both credit and high yield, particularly high yield, we would say that valuations are now beginning to look pretty full actually. Spreads have narrowed a lot, absolute yield levels have obviously fallen quite some way. And companies are beginning to do some relatively un-bond friendly stuff, a lot of M&A activity going on. So we think the outlook for credit is now looking more muted than it was, and particularly in high yield have taken some money off the table there. Outside of credit, equities still look okay. Valuations are full, but supported by the growth outlook, we think, and the earnings cycle is looking more positive. But within credit, valuations are now looking pretty rich.
Mark, thanks very much.